Jeni Browne. Welcome to MFB News. Hope everybody is fantastically well. It's been 2 weeks since we last caught up. Quite a bit's been going on, not huge amounts. And sorry I wasn't here last week. I was in Budapest, which was absolutely lovely. I'm just going to turn into a travel advisor rather than a mortgage advisor for a second. Not the best European city I've ever been to, but still very, very beautiful, very complicated history. For those of you who are into your history, it's definitely a city which is worth going to. For those of you who just want loads of great shopping and foods and bars, that's on offer there as well. But like I say, probably wasn't the best European city I've ever been to. Anyway, let's move on to what we're really here to talk about today, which is mortgages and the buy-to-let market more broadly. And what are we going to be covering off for you? We're going to be talking about what's been happening with swap rates, lender pricing changes. We're then going to move on to the latest thoughts of what's going to happen with base rate based on the news about GDP, which came out last week. That was a real nice treat when I was on holiday. We're going to talk about a report that Fleet Mortgages have released, which is going to give us information on yields, so how rental yields are performing by region, who's doing well, who's not doing so well, and which of the highest performing areas could be useful for those of you who are thinking about buying and are chasing yield rather than capital growth, because the two don't tend to go together. And it could be that actually, that could be quite useful. And then finally, we're going to wrap up with some information on the Leasehold reform bill. Okay, so 2 weeks out of the loop and no real change on swap rates. So 2 years are at 3.56, 1 month ago 3.71, and 1 year ago 4.33. So we're in a very similar situation to where we were 2 weeks ago. So the same situation for 5 years, unsurprisingly. 3.65 for 5 year fixes as of last night, 3.68 1 month ago, and 4.08 1 year ago. So I think the kind of ultimate thing that I take away from this is that actually we're in a relatively good place compared to where we may have been over the last, or in the journey of the last few years. So first of all, 2 and 5 year fixed rates are slightly lower. I mean, slightly 0.1%, so nothing life-changing, but still they're going in the right direction compared to where they were 1 month ago, and we're definitely in a better position than where we were 1 year ago. What does this do? This paves the way for lenders to make small pricing adjustments because their cost of funds has come down. We'll come on to that in a moment. But actually, there's nothing really big going on that's going to make any material kind of step change to swap rates. So as I mentioned, or we talked about in a video with David Whittaker a couple of weeks ago, who's really kind of very, very knowledgeable about this kind of stuff, what he's saying is actually, fixed rates might come down by 0.1, 0.2%, but at the moment there really is no great change expected on the horizon. So for those of you who are holding off, hoping for rates to come down, especially if you are seeing a base rate movement or a base rate reduction in August, it could be that actually the markets have already priced that in, and so you still won't see any great changes on fixed rates, but we'll obviously keep you posted. Now, in terms of lender pricing changes, I'm not going to give you 2 weeks worth of lender pricing changes because quite frankly that's boring, but what I am going to do is just give you a quick rundown about what's been happening in the last week, and there is some good news in here, guys, so please don't lose heart. So first of all, we've seen Clydesdale reduce rates by 0.15%. Clydesdale, they are a lender that is very, very nichey. So what they do is when they're looking at affordability on a buy-to-let mortgage, what they're doing is looking at all of your income and all of your outgoings. So what that would mean is I have a day job paying me 30 grand a year. I have rental income on my buy-to-let property of, £500 a month. And I have, some maintenance money from my ex-husband or something along those lines. That's my money in. So that's treated as your kind of income. Then what they do is they run an affordability check based on all of your background debts. They're going to include all of your mortgages, including your home mortgage, lifestyle kind of expenses. So if my husband's paying me maintenance, they're going to know that I've got a child. Therefore, do I have school fees, childcare costs, all that kind of stuff. They're going to look at any loans, HP. So essentially, it's all affordability based, which means the net effect of this is that actually it only really works for those lenders, those borrowers who have a relatively low debt in the background but good income. Where this comes into its own is for those people who are really struggling on rental calculations. So the rental calculation Clydesdale uses is actually like probably the most generous on the buy-to-let market, but it's only available to those people who, really sort of show the point, have higher incomes and lower background debt. So really the way I would see this working, where we see these mortgages come into their own, it tends to be for properties in the southeast where the yields are pretty low. For landlords looking to gear up, it's normally a landlord who's got a good job in the city, for example. I'm really stereotyping here, by the way. A good job in the city and then a relatively low level of borrowing in the background. Then it can work really well and be a real saviour for some people. Now, Paragon have reduced some of their 2-year fixed rates by up to 0.15%. There's a bit of a theme here today. Paragon, we talk about them often, so I won't go into them in too much detail. Leads have made some reductions to their product transfer rates of up to 0.15%. So if by very slim chance you are someone who's applied for a PT rate, product transfer rate with the Leads, might be worth just seeing if they've reduced their rates, and you can go contact them and ask them to bring you down to the new lower pricing. TSB, rates down by 0.1%, BM Solutions down by 0.3%. TSB and BM Solutions, very similar lenders. They're kind of like volume based, stack them high, sell them quite cheap type lenders, no more than 10 mortgage properties in the background, no minimum income requirements, no limited companies, no HMOs, no multi-units, that kind of stuff. One of the things that these are really good at, so TSB are particularly fantastic if you are looking to rent out the property in which you live and you haven't got an onward purchase. So generally speaking, if you're going to do what's called a let to buy, so you're going to rent out your existing home and put it onto a buy to let mortgage, lenders only get really comfortable with this if there's a kind of linked purchase transaction, so they can clearly see where you're going to be going. The other way that we get around this is if you have actually moved out of the property, it's rented out, and there's a clear line between you being in the property and no longer in the property, then lenders can get comfortable. TSB are a bit more flexible on this, which can be quite useful. As an example, I've got a client at the moment who is living in a house. She wants to rent it out and move in with her boyfriend, but she doesn't want to do that until she knows she can get the mortgage. To TSB are a great fit for her. BM Solutions, these guys are just really great at pricing. Their pricing is probably market leading at the moment. Their service is very good. The other thing with BM Solutions is they don't have a lot of rules around properties. It's always down to valuer's comments. So if you've got something over commercial, if you've got a studio flat, if you've got something with a slightly unusual construction, these guys can be very good. It's always going to be down to what the valuer has to say about lettability and saleability. And lastly, in the last week, we've also seen Commentary bring their limited company rates down by a smidge also. So all good stuff. Interesting that it's mainly clearing banks repricing this week, probably largely because we haven't seen much change in swap rates. So those more specialist lenders who are very reliant on the capital markets, because swap rates haven't really moved in the last couple of weeks, we wouldn't expect to see much changing. Now I thought what I'd do this week, because I haven't done one for ages, is a quick pricing roundup. So what I've done is I've taken a loan amount or a mortgage amount of £250,000. I'm working on a loan to value of 65%. And this is kind of like here at MFB, our kind of average transaction. So 65% loan to value, average loan size, £250,000. So just to be clear, you can borrow less than this, you can borrow more than this, you can go to a much higher loan to value, 80%. It's very much available in the market. But this will just give you a flavour of where rates are at the moment. And what I've done is, rather than take the headline lowest mortgage rate, which would be very easy to do, but it's a bit lazy and also a bit kind of false, misleading really, what I've done is I've taken the deal with the average cost over the period of time. So if it's a 2-year fix, it's all the interest you're going to pay over 2 years, plus all the setup fees. And I've taken the deal which works out lowest on that basis, which here at MFB we regard as the best deal, because in the round it's the most cost effective. Lower rates are available, but the overall cost will be more expensive for you because you're going to pay much higher setup fees. So to move on to that then, so personal borrower borrowing on a straightforward property, so no HMOs, no multi-units, 2-year fixed rates from 3.92 with a £1,499 fee. 5-year fix from 3.97 with a 1% arrangement fee. Trackers, because people are very interested in these at the moment, 4.68 with a 1495 fee. And then if we move on to limited companies, the same kind of process, the same metrics I'm using here. 2-year fixed rates from 4.89 with a 1499 fee, 5 years from 5.04 with a 1499 fee, and trackers from 5.58 with a 1999 fee. And like I say, these aren't the best deals for everybody. If you had a loan amount of £1 million, the best rate would kind of shift as it would if you were borrowing £50,000. This is just to really give you a guide, but at least I hope you find that helpful in terms of giving you a kind of flavour about where rates are sitting at the moment. Now, we saw the GDP figures come out last week, which showed that GDP fell in May by 0.1%, following a decrease of 0.3% in April and 0.4% in March. Now, production was one of the main downward drags, with output falling by 0.9% following an unrevised fall of 0.6% in April, and construction also fell by 0.6% in May. So despite 2 consecutive monthly falls, GDP rose by 0.5% over the 3 months to May, driven largely by the services sector. So industry experts on the back of this news were saying that the falling GDP means a cut to base rate in August was now firmly on the table. So actually, bad news for GDP. Obviously, we want the country to be growing, our economy to be growing, not shrinking. But actually, in terms of those of you hoping that mortgage rates are going to come down, you could see that as a bit of a win. However, also this morning came out the inflation news. So for those of you who are yet to catch up on that, essentially inflation, according to the CPI index, not the CPIH, rose 3.6% in June compared to 3.4% in May, which is a significant jump and actually unexpected. This is largely driven by food prices and also transport costs. So this is kind of what's going on. So on one hand, the MPC have got a kind of SOS from the UK economy saying, you know, we're shrinking, we need to grow, we need you to help stimulate things, you need to drop interest rates. But on the other hand, inflation is starting to kind of pick up again, which is bad news. It's going to be really interesting to see what happens with base rate in August. I suspect we will see a drop in August actually of 0.25%. That's just kind of my feeling for that. And there's no kind of real logic behind it other than I just think that growth is so important. Obviously, Labour, our government, are kind of really focused on growth at the moment. Obviously, I say obviously, for those of you who don't know, the government and the MPC are very, very separate from each other. But of course, the MPC are going to be very mindful of the fact that the economy is kind of stalling, and it's stalling month on month. Okay, we kind of do 1 month forward, 1 month back, and therefore the net effect is that actually we're just kind of stuck at the moment. So they're going to be very cognizant of that. However, the inflation numbers are also worrying. What's particularly worrying, I think, with that is that actually food inflation, which is kind of picking back up again, people can't cut back on food shopping. You know, we need to eat. It's a very basic fundamental requirement. So actually, I don't know that, you know, this is people kind of out, you know, spending money fecklessly. This is actually people just kind of existing. So it'll be interesting to see what happens. But like I say, I still think we will see a 25 bp reduction in August, but obviously we'll be relaying market commentary and what the experts are saying as we kind of build up to the August base rate announcement. Okay, now for those of you who are thinking about going house shopping and are very, very focused on yield, and not everyone is, it sounds like an obvious statement, but actually some people are more focused on capital growth or actually just kind of getting a good yield rather than the best yield. But for those of you who are really interested in yields, this is going to be particularly interesting to you. Also be interesting for you to see how your existing portfolio, based on where it's located, sits against the rest of the UK. So the Fleet Mortgages Rental Barometer for Q2 2025 shows that rental yields have remained resilient as buy-to-let landlords continue to invest across England and Wales. The average yields in England and Wales were up again, reaching 7.5% in Q2 of this year. Wales has jumped to the top spot with an impressive average rental yield of 9%. That actually is really impressive. There are parts of the country which don't generate that kind of yield on HMOs, so the fact that Wales just getting that as a kind of default is really good. So Wales is your yield top spot at 9% at the moment, guys. Limited company borrowers continue to dominate, making up 81% of all applications. This is for Fleet, though, who are a specialist mortgage lender, so this is just according to their data, not the whole mortgage market. High demand, so 39% from those looking to add properties to their rental portfolio. So actually a lot of landlords are in growth mode at the moment, and first time landlords holding steady, representing 14% of all applications. So it's a good mix actually of existing investors reinvesting or going again, and actually some new people to the mix as well, which we do really need as we've got a kind of series of more mature landlords kind of demurely exiting the market at the moment. So in terms of yields, where are we? So your top spot, as we mentioned, is Wales at 9%, Northwest 8.8, and North East 8.7. They're all really impressive figures, aren't they? Yorkshire and the Humber 7.9, East Midlands 7.5, the West Midlands at 7.2, Southwest 7.1, Southeast 6.5, East Anglia 6.2, Greater London 6%, bringing the average UK rental yield to 7.5%. So really, really good. There are some regions who have actually seen a dip in rental yield there. The dips have come from the North East, West Midlands, East Anglia and Greater London, who've sort of marginally come down a bit on yield. But other than that, all the other areas are growing in yield, which is fantastic news for investors. Okay, now the Leasehold Reform Act, and I know there are a whole wave of landlords with leasehold properties who are letting the leases run down while they wait for the Leasehold Reform Act to kind of come into play. Why are they doing this? Because it's going to save them a bunch of money when they extend the leases, basically. The challenge here is that actually shorter leases become quite hard to finance, and lenders sit on different pages with this in terms of the minimum leasehold requirement. So broadly speaking, anything over like 80 years is fine. And when you get below 80, you start sort of seeing a reduction in the choice of lenders, and anything under 50 is like a bit of a nightmare, if I'm brutally honest with you. So if you are someone who is sitting on your hands waiting to extend a lease, because you're waiting for the Leasehold Reform Act to come through, understandably, right, because actually this is a big thing for leaseholders. In terms of cost saving, actually do give us a shout, because we do have lenders who can take relatively short leases. So just to kind of give you a view on the scale of this, so up 40% of all properties in the PRS are actually leasehold, which is about 1.8 million properties. So this is it's a big deal. So there's been a bit of movement. So things have gone very, very quiet on the Act since really 2024, but there has been a little bit of movement. So what they've been saying is that essentially a consultation on service charges reform that was due in the spring came out on the 4th of July. So this is what we've been waiting for. The consultation also includes the government's proposals on changing the Section 20 major works process and the treatment of litigation costs, together with introducing a minimum qualification for managing agents of blocks and freehold estates. So essentially at the moment, managing agents of freeholds don't need to have any qualifications, which is absolutely bonkers, isn't it? So there's going to be a qualification introduced for these guys, which is great. So in terms of progress, what are we waiting on? So enfranchisement premiums, I'm not sure how you say that, which is going to be in the summer of 2025, so that's imminent. Estate management charges consultation in 2025, no season has been specified. The future of ground rent for existing leases, date and details are still unspecified. A draft leasehold and common hold reform bill will be out sometime later on this year. So for those of you who are kind of worrying it's all gone very, very quiet, it does look like things have been dipped back into earlier this month, and we will of course continue to keep you posted as and when there is more news. And that's me for this week, guys. Thank you so much for watching or listening, depending on how you do this. Or actually, some of you even read this now, I think. So however you digest this, I hope it was helpful. And as always, if you have any questions, you can give us a call, 0345 345 6788, or come and have a chat with us via our online chat system on our website. You know the drill. Have a really good week. For those of you, I think a lot of you who have children will be now facing the summer holidays at the end of this week. We're into our second week for summer holidays already, so yeah, almost 2 weeks down, well, a week and a half down, and just 7.5 more to go. I will be drinking gin recording this in future weeks, don't worry. Look after yourselves, and I'll see you next time.